So we might get started. Thanks everyone for tuning in today. We've got hundreds of people tuning in. My name's Natasha. I'm from the Mable marketing team. And before we get started, I'd like to acknowledge the traditional custodians of country throughout Australia and recognise their continuing connection to land, waters, and culture. We pay our respects to the elders past, present, and emerging. We extend that respect to Aboriginal and Torres Strait Islander people here today. So today I'm joined by Emma Baxter. She's a specialist tax advisor and director of YOUtax. And Mable has had an ongoing partnership with YOUtax over the last 4 years through the Mable Tax Benefits Program. It allows independent support workers on Mable to receive tax advice and exclusive discounts through YOUtax. So I'm really excited to hand it over to Emma today. She's going to guide you through our webinar on superannuation. Take it away, Emma.
Hi guys, I've seen a few familiar names through the participants who have joined today. So some who I've spoken to before, so welcome. If there's anyone who's been on a webinar of mine before, please put your hand up and hopefully you're getting some good takeaways from these webinars. And I would also like to thank Mable for inviting us to come in to share all this knowledge and support that we can give to you. Now, as Tash said, there is a workbook at the top of the webinar chat. So we can even copy it again and pop it out throughout the webinar to make sure that everyone gets a copy of that workbook. You can download it in digital form, or you can print it out and follow along. There's some little activities in there and notes that you can take that will help you. There's also a little bit more in-depth information in that workbook to what I'm going to hit, like a lot of the highlight points. So superannuation is a big topic. So when we talk about superannuation, everyone has a different view. I come from a tax perspective. You're coming from someone who's going, oh, how much do I pay? When do I pay? How do, or what benefits are available? So we're going to cover all of those today. So we're going to first, before we do jump right into super, we're going to look at some of the tools on the Mable platform. And then we're going to jump into why super matters, the government benefits that might be available to you at your income level, how much you think you should be contributing and when, and how to make those contributions. If you don't have a super fund, how choosing the right super fund for you, or if you're wanting to change or find some more super. We're going to go through a few of those details today. So I can see that the link cannot be found. So they will pop that link back in there for you in the channel. So great. So the purpose of this webinar is to improve your financial well-being through education. The information provided is based on current legislation and is general in nature. So it doesn't apply your specific circumstances. So you may identify with some of the examples, but ensure that you consider the topics in relation to your personal and family circumstances and then seek qualified advice. So just note, we are talking about superannuation, and so I'm going to be keeping things on general information because I cannot provide financial planning advice. So anything in regards to tax or tax strategies or contributing to super and how to do that, yes, I am your girl. Anything that is to do with choosing a super fund and how you should be investing your money, that is a financial planner. Okay, so we're going to jump into the billing tools that's available on Mable. So they've got lots of great resources. So they've got invoices and payments, your business net income summary, that's the one that you give to me every year. You've got some great CSV exports, CSV, and we've got super and tax calculators and tax and super sync. So we're going to focus on a few of those today. So this is probably what you recognize when you're going into your Mable platform. The area that we're looking at today and the area that I will be discussing come tax time when I'm asking you for information is this billing area. Okay, the biggest, the one thing that we always ask when clients are coming through is to provide their Mable statement, and that's here at business income. And then there are ways that we use the exports to help Mable independent support workers to maybe track some kilometers where they might be seeing, oh, when did I visit that client? If they don't have a logbook, there are some good little tools that we have some workarounds to gather information from you. However, our focus today is going to be on tax and SuperSync, along, partnering that with Super. So how many of you in here have, so I'm just copy that URL and put that in the chat here and see if that one works. If someone's saying that it's not coming up for them. Okay. So when we're looking at tax and SuperSync, there is a feature within your Mable that allows you to have a percentage of your invoicing going to either your super account or your tax account. That's a great tool. That means that you're putting that money aside before it comes to tax time, allowing you to make those saves. Now, a couple of things that you really need to know about the SuperSync is it is a tool for you to save from your invoicing. It doesn't go directly to your super fund. So therefore, you need to then follow on in this webinar, and we will talk about when you make those payments to your super fund to ensure that if you've been saving all year for super, that you make sure you get that tax benefit. Okay, so and then obviously your tax contributions, it helps when you're doing quarterly IASs that you need to pay to the ATO and all of those kind of ATO compliance obligations that they put you on as an ABN sole trader. Now, there is this other tool that you can that can help, that is a bit of you to jump in and go, okay, it draws from your data. So therefore you can sit there and go, okay, from my invoicing, it's 15%, which is quite a generous super rate in there. But if you were looking at 10 or 12% that you wanted to put aside for super, it will calculate based on your invoicing and will give you an amount down here that is your indicative super rate. So it kind of like if you said, I wanted to put 10% aside or 12% aside or 15% aside, and you put your financial year numbers in there, that will tell you how much that you should have put aside for super if that is your goal. Also, the same for tax. So what it does is you're actually putting in your tax percentage. So you'll be looking at what your effective tax rate is. We won't be talking about effective tax rates, but I have put a little table in your worksheet for it. But we won't be talking about it today because we're doing a whole webinar on tax and deductions and tax time in July. So that's where we're going to cover off those topics. However, if you know your effective tax rate and it's around that 20-22% mark, then you can actually have your invoicing pulled through and to be able to find out how much tax would you have been required to put aside for you at tax time. Okay. I hope that is good. Are you saying that you can't hear me? Some people are saying that they've got their volume on max. Can people let me know, can they hear me in the webinar? Yep, hear me fine? Great. Thank you. Okay, so we do have the chat here, and we do have a couple of our tax accountants here that many of you may have spoken to. We've got Cass and Chelsea on the line. So if you have any questions, put them in the chat tool. And then when we make a break and have a stop, I'll go through some of those questions and make sure that we're getting the most important ones that I'm covering through this session. Okay, so you are an ABN independent support worker, which means you are responsible for your own retirement savings. There's no employer there that is putting aside your 11% that can be contributed to super on your behalf. So when we're talking about this, you're responsible for your tax, you're responsible for your super. Now, I can tell you there are many people working under an ABN that need to get into a good structure and a good environment where they are putting that tax aside, because it is not compulsory for an ABN support worker to contribute to super. However, that provides for a lot of missed opportunities over time that you're missing out on gaining those super benefits for retirement, access to tax benefits, or understanding some of the government incentives we're going to go through. So super is very important. We all know that super is very important, and it's obviously it's our retirement security. We're putting into super so that when we retire, we're not solely reliant on the age pension that the government provides. And some people might be seeking self-funded retirees. So you got that bit of extra cash at that time. Because it is saving for the future, it is concessionally taxed. And there are tax benefits that can help you. Especially for low income earners, and for those, there are tax incentives for those looking to purchase their first home. So knowing that you've got a routine and you've got your super being put aside gives you greater financial independence, because that is effectively what super is giving us. It's giving us choice and financial independence when we retire and we don't have that regular income. So this is the practical part. Okay, this is the data part. This is the part where I go, okay, what is your super 101? What are the facts around super? So the facts is that super is taxed at a flat rate. It's a concessional rate of 15%. So when you think about it, if you're in the 30% tax bracket and then super is being taxed at 15%, you're getting a tax benefit. Okay, but remember, there are other super rates. So if your income is under that 30% bracket, say 16%, you're like, why would I contribute to super if I'm only getting a 1% benefit? Well, there are government incentives that allow you to not have to pay that tax at certain income levels. Okay, so what we're looking at here is if you're a high income earner on 250,000 of your income plus super, you do pay 30% on your super contributions. Your income tax is at 47%, and then you pay 30%. What we've got here is the concessional rate, which we'll mostly focus on today, at 15%. And then we're going to talk a bit about later about claiming your super tax benefit. But for many of you, when you're contributing to super, it all depends on what your income is and what threshold you fall into in the income tax thresholds. Okay, so remember, this is in your webinar, in your workbook, and so you can write some notes about what do you think, where do you fall in your income threshold, and what could you be looking at in some of the government benefits. So here's a little example that I just put of the tax difference of someone who has with super or without super. So let's just say you're working, you're earning 65,000 a year. Okay, this is GST free, under the GST bracket. You're claiming the cents per kilometre method, and you're at 4,250 in expenses, and you've got a little bit of professional development and client expenses there. When we're looking at your income minus expenses, you're still in that 60,000 bracket. Okay, so your tax payable is around 10,000. Let's say you put in 10% super contribution over here. Okay, not only are you contributing and saving for your retirement, it also reduces your tax here at 8,020. But remember, we talked about how there's 15% tax within the fund, so you are getting a net benefit of $1,105. Okay, so the tax benefits are there for you. And so in this case, on taxable income, it's saving you $2,080, and that's allowing you to contribute and grow for your super benefits. And effectively, once they take the tax out, we like to talk about net tax benefits. So it's like the true tax benefit. Even though you're being taxed in the income system or the super system, we want to talk about the net tax benefit, which is $1,105. Okay. Now, this area here is an area where people are more on the low income side. So say they've got this as a part-time job, or they're nearing retirement, semi-retired, and they're not working full time. there are some government benefits because, as I said before, it's a bit like, oh, why would I contribute to super if I'm only getting a 1% tax benefit? However, you still want to make sure you're contributing to super because there are government benefits that can help you. So if your income is less than 45,400, what you can do is by contributing $1,000 to super, the government will match it with a co-contribution of $500. So that's a 50% return on your rate. It's better than 15%. And so, but that is to help those on low incomes to be able to contribute to super. And that is with a non-concessional contribution. So a non-concessional contribution is where you're paying it with after-tax dollars and you are not claiming it in your tax return. So there are many clients of mine last year who were like, I saved all this money for super and their income was quite low. We're like, great, we're going to put it in here. We're going to put $1,000 in as a non-concessional contribution after tax. We're not going to claim it in your tax return. The government is going to give you $500. Then with the excess that they had, so let's say they had $2,000, we contributed another $1,000 and put that into super. And then what happened was the government provided the low income super tax offset where that anything, if your income is under $37,000, you do not have to pay tax on that super within the fund. Okay. And that's up to $500. So just like the co-contribution up to $500, this was also up to $500. So when you're contributing, let's say you are on 37,000 and you're wanting to contribute 10% of your super, 10% into super, you're effectively paying $55, okay, by making that contribution to super that is going to be growing within your super fund. So this is the tax side of what those government benefits are. The next benefit, does anyone have any questions around that at the moment? Or is everyone on the chat a bit above that threshold? That's good. Okay, so I'll talk about the next benefit that we have is the spouse contribution. So that could be you contributing for your spouse or your spouse contributing to you. Okay, so this is in the term of if you're going to be contributing for your spouse, you can make an after-tax contribution to your spouse's super fund, and we usually only contribute $3,000. Okay, and then they get the tax offset. So not the spouse is getting, the spouse is getting the contribution, and the partner contributing is getting a $540 tax offset. So that's equivalent to 18%. Great question. Are they asset tested? At the moment, okay, so there's a question that's come through from Sam regarding the government co-contribution and the Lamido. Are they asset tested? If that's what you're talking about for pensions and things like that. I don't believe that they're asset tested. If your superannuation is not asset tested in your pension, then these contributions will not be asset tested because they are going into your superannuation balance. If your superannuation balance for you is being asset tested, then that answer would be yes. But that is something that you would speak to Centrelink or a financial advisor on understanding which is asset tested. Okay. So in this case, you are actually eligible for all three of these benefits. So you could choose to make the co-contribution. You could also, which is a non-concessional contribution, you could also make a tax deductible contribution if your income's under 37,000. And if your income is still under 37,000, you can still have your spouse contribute for you as a non-concessional contribution. Okay. Now there is more detail in the workbook for you on that. Now, is there anybody, any young ones here, or anybody looking to purchase their first home? I won't go into this too deeply if there's not many of you on this webinar at the moment, but there is another government benefit called the First Home Super Saver Scheme, especially for those that are ABN workers. Every contribution you make to super is actually goes in as a personal contribution, which you can later withdraw to put towards your first home. So this is great. You've got people here buying their first home who are online with us. Fantastic. Congratulations. So what happens with your super? If you're an employee, your employer makes super contributions on your behalf. They do not count towards the First Home Super Saver Scheme. As an ABN worker, all of your contributions go into the super fund as a personal contribution, whether they're deducted in your tax return or whether they go in as a non-concessional. You can actually withdraw them for the purchase of your first home. So the government introduced this to try and stimulate spending for their first home. So it means when you've got your deposit sitting in a bank account, incurring interest, in incurring that interest, you then pay tax on that interest at your tax rate. When you are contributing to your super fund, the interest is in there, is taxed at the concessional rate of 15%. Okay, you can contribute up to $15,000 a year, but you can only take out $50,000 across, a 3 to 4 year span. So if this is one of your strategies, I recommend that you speak to an advisor talking about how much you should contribute to super and how it fits with your ABN income or any other income that you may have, and how that can benefit you. There are some pretty strict rules around it, in the fact that you can all do it. You make your contribution to your super fund. However, everything is through your MyGov account. So in your MyGov app, when you go to sign that contract, you make sure you sign a release to have those funds released. And you want to do that before you're signing that first contract, or as you're signing that first contract, okay? It needs to be a personal property and not an investment. So in the workbook, I've created a link that is for all of the eligibility requirements. So as long as you're over 18 and that you have never owned a home or land or property in Australia before, you are effectively eligible for this government benefit. So I'll be putting an asterisk on that one for a couple of you in here. Now, here's a little stop point if anyone's got any questions that they would like to ask at this point. Otherwise, I will move on because there is a lot of questions. Okay, I've got one from Pia. You can make contributions monthly or annually. Yes, this is exactly, you've just done my segue, Pia, into how much to contribute and when should we be contributing. Okay, so as I mentioned earlier, you're an ABN support worker, so therefore it is not mandatory for you to contribute to super, but obviously it's beneficial for you. Many people like to mirror the super guarantee charge rate that is done by employers. So many people, for ease, will aim for at least 10% going into their super. When they want to mirror the super guarantee charge rate, we're looking at 12% from 1 July. All employers are contributing 12% to your super fund. Okay. A few little notes around super is you can contribute up to $30,000 a year now. It used to be 27,500 and previously it used to be 25,000. The contributions that you make to super are the contributions you make can be employee contributions plus your personal contributions. Okay, so that 30,000 is both. Or if you don't have another job or any other income coming in there, then you can put 30,000 up into super. However, you want to make sure your tax talk to a tax advisor so you can get the most tax benefit out of that contribution. Now, when we're talking about super, it's retirement. We can't access this money till age 65 unless we have access to the first home super saver scheme, or under special circumstances of if you fall ill and need medical treatment, you can access your super, or if you are in, financial strain, then you can apply to release some of your super early. The non-concessional cap, that is a cap where you contribute with after-tax dollars. You can put $120,000 a year. So if anyone is, has a rich auntie who's looking to give them some money, or you've got an inheritance coming through, or you've got lump sums from, property investments or investments that you are going to execute, then have a look at what you can do by minimizing those that tax through super. Okay. Now, when should we be paying? That question is kind of an open question, and it depends on you. Okay. You can make regular contributions monthly, quarterly, or fortnightly, but you want to tailor it to your business. Okay. When you do make regular contributions and you do it monthly, that's great because you're getting the benefits of your investment compounding, so that all the returns on that are compounding over time. It also helps with what's called dollar cost averaging, where it smooths out the fluctuations of income going in. Or you might sit there and go, well, I need to report to the ATO my installment activity statement and pay my tax quarterly. I may as well combine that and pay my super quarterly. So setting that task that is, okay, when I have to pay tax, I need to pay super. And if you're using the super sync account, you can then go to that bank account and transfer those funds to your super account, as well as the tax to the ATO. So it's a really great tool. So regular contributions, if you are regularly working, then that is great. And you want to have that routine of a percentage coming from your invoicing or your income, then regular contributions are a very good way to go. The other thing is lump sum contributions. Okay, if someone's had a big quarter and they're like, oh my God, I work so much I don't need the money for anything, I want to put it to super, that's my goal, then by all means, you can make an additional lump sum contribution in any quarter. Okay, or at the end of the financial year. This is a time where we do a lot of super tax planning, where people sit there and go, okay, well, I'm right to the end of the year. I'm looking at my income. I'm looking at how much tax am I going into another tax threshold? Are there any benefits for me to contribute to super? And so May is a good time for us that we do super tax planning. So that is another lump sum contribution when people tend to contribute to super. We have some people who will have it offset their mortgage for the whole way through because they want it sitting in an offset account and saving the interest on their mortgage. And then they will do a lump sum and send it to the ATO at the end of the financial year. So you're still getting those tax benefits, whether you contribute through the year or at the end of the year. However, where do you want those benefits? Your tax savings on your mortgage, or you're getting those investment compounding or those dollar cost averaging through the year. As an ABN support worker, you do not contribute super to your fund as an employer. Okay, some people have made that mistake. It's like, oh, well, I employ myself, so I need to contribute as an employer. You are contributing as a personal super payment. Okay, and you just need to contact your super fund and get your direct debit payments, direct details from them, and then you make those payments. You must make the payments before 30 June. Okay, if you've been saving for super all this time this year and do not make that payment before 30 June, and when I say before 30 June, I'm going to premise that to the 15th of June, because you need time for that super to process and go into. So the very latest, you want to make that contribution by the middle of June so that they can process and have the money in your super fund. If you're getting the low income super tax offset or the co-contribution, If the money isn't dated in your super fund on the 30th of June or prior, you miss out on those benefits. So being organized, setting yourself a task, making sure you get those payments in before the 30th of June is really important. For those of you, you've now done the first step, you've got the contribution, you've popped it into your super fund. What happens next? If you are, all contributions going into your super fund go in as a non-concessional contribution, meaning the super fund will not tax it and then until you tell them that you want a tax benefit from it. So it will go in as like an after-tax contribution. For us to claim your super in your tax return as a deduction, you then need to reclassify that contribution from non-concessional to concessional. So many of you who I know on the webinar today will hear the word notice of intent to claim. It is something that you must complete when you pay your super. Now, it is not that urgent that, okay, I paid the super and I complete the form. The form is necessary to complete for when we perform the tax. Completing it as soon as when you wish is fine. The minute you complete that form, they will take the tax from your payment within the super fund. Okay. The other side of it on the notice of intent to claim is if you made a contribution before 30 June 2025, you need to make sure that notice of intent to claim is submitted. You can't forget it before 30 June 2026. Otherwise, you lose that super benefit. It stays in there. You've got 1 year to make sure you complete that form. Okay. So any questions around that? That was a lot of information in that moment, but yes, making sure that you pay your super directly to your super fund and then making sure that you complete that notice of intent to claim, and the choosing whether to have regular or lump sum contributions, that is totally up to you. So it says for Larry here, thank you. It sounds like I need to speak with a financial advisor. A financial advisor is someone who can help you decide what fund and what what risk profile that you want to put your funds in. So yes, and they can also help you for retirement planning. So here's the summary of what I just discussed with you. You can make those regular payments to super for consistency, steady income, and you can automate it. You can set it up to your super fund as a direct debit from your bank account. Or you can do it quarterly where you're aligning it with your BAS or your IAS and setting it at that time. And you just make sure you're setting yourself reminders and allows you to check your cash flow. Lump sum, irregular income, or whether you have a windfall or doing some end of financial year planning, or you've had it sitting in your super sync account all year and you're like, oops, I better go put that in my super fund. Those lump sum ones are great. So the most important thing is that you make sure that you're contributing and you're contributing that it suits with your business. Okay, so, and that's where we were talking about the super sync. This is where it comes in. Whatever your balance is there within your super sync account, that's coming out automatically from your invoicing. That's what you transfer to your super fund. So now we're going to move on. If nobody's got any questions for me right now, I'm going to scoot ahead to make sure that we've got more time. So we're going to talk about choosing the right super fund. So this is something that, was mentioned earlier. I better see a financial advisor. Now, I understand that many of you can't afford to pay for a financial advisor. And so when you're sitting there going, oh, financial advisors are really expensive. What am I going to do? Don't do nothing. There are things that you can do. Now, I'm just looking at the ATO has what's called a super comparison tool. So they put all the super products in the ATO, which allows you to compare the fees, performance, and features. So there are free tools available for you to do your own research. So unfortunately, oh, Carolyn's got a bit of rain going on there. And so, oh, I wonder what state you're in, Carolyn. So when we're looking at choosing your own super fund, what are the key features that you need to be thinking about when you're choosing your own super fund? So first of all, you want to see that the fund is performing, okay? And you don't just rush and go, okay, what were last year's results, 1 year results? You've got to remember that your super is a long-term investment. We've just had Trump who crashed all our markets and super funds recently, and we're waiting for those to recover. So looking at short-term results is not necessarily the best. You want to look at long-term results of the performance of the fund and make sure you're happy with the long-term results. This is not just choosing a fund. You can use all of this to go and reassess your current fund. Okay, so I had to go back and recently look at my investment and sit there and go, oh, I wonder how it's performing. And I was quite surprised it was performing a little bit better than I was expecting. However, just like most people, it did suffer with some of the Trump tariffs that came in and the way the share market was reacting. So first you want to look at performance. You also want to make sure when you're looking at the performance of the fund that you're looking at balanced funds versus balanced funds. So you want to check, what is my risk profile? Am I an aggressive investor? Am I a balanced investor? Am I a conservative investor? That's about you as a individual. What is your risk appetite? Okay, what is your, if you sat there and you were going up 1 year and down 1 year, and had losses the next, does that make you anxious, keep you up at night, where you can't sleep when you're looking at your super? So making sure that you're finding funds that actually fit your risk profile is important. The other thing is fees. Okay, fees are important. We're going to look at returns. You also want to look at the fees. If you've got great returns and they're performing well, and that means they're doing their job and they have some fees, then that's okay. However, if you've got something that's performing pretty average or not so great, and you've got high fees, remember that is eroding your super. So lower fees will mean more money in your super over time. Okay, if we're looking at 10, 15, 20, 30 years till the age of 65, then you might want to have a look at your fees. The other thing is also, I am a big advocate for women and super. Okay, sometimes our income, we have the gender pay gap, we have less super, we take time off for family reasons, and our super is performing poorly. Okay, making sure you plan for those times. If you're not ready for children and you're not having children, making sure that you educate yourself on your super, that you focus on super. I can tell you from first experience, I stayed at home and raised my children. They're all, I think my youngest is 16 next week, but they are all older now, which allowed me to go back into full-time work. But I stayed at home for 10 years. My super was terrible because I only worked casual jobs, keeping myself connected to the industry. Okay, so what happened in that when I chose to stay at home with my children? Now I have a big focus on my super. So I'm having to put a lot in now for a short period before retirement. So for those of you who are younger on the chat, on the webinar today, making sure that you sit there and go, okay, super is important. You might sit there and go, wow, I'm getting paid a lot and I could buy a new car, or I could pay for this. And you might have student loans or things that you need to pay, but focusing on that consistent contribution to super for long-term effect. If you're somebody who doesn't believe in super, making sure you're putting into some long-term strategy for you for the future is still important. Okay. Making sure you understand your investment options. We talked about risk tolerance earlier, growth, balance, conservative. Do you prefer ethical investments? They're very important. Now, this one is also very important to note is insurance. There is insurance that can, sometimes people sit there and go, oh, my life my TPD, my income protection, it erodes my super fund, and you see it coming out. You need to check what is your personal understanding around life and TPD and superannuation. I have been paying my life insurances for a long time. When I took that time off with my children, raising my children, I've been paying my premiums for a long time, and then my super fund just cancelled. The government brought a new legislation in that I wasn't aware of because I was too busy feeding babies and changing nappies, that if you didn't contribute to a fund, they would cancel the insurance policy. TPD is total permanent disability. So you've got life insurance, total permanent disability insurance, or income protection insurance. They are common insurances that will be sold within a super fund. Okay, so you want to make sure that you're reviewing that and looking at it. Does it meet your needs? And we're going to talk about when you consolidate super. Okay, make sure when you're consolidating your super, everyone says, go in, consolidate super, you're going to save the fees. Review your super fund before you consolidate the super, because you could be losing an insurance policy that you may never get again. There may be pre-existing conditions that came after you started the policy. The premiums of a new policy may be higher. So making sure the insurance meets the needs and making sure you're aware of what the cost is. I could see that it happened to somebody else. Yeah, it was a bit of I then had to go out and get personal insurance to make sure that I was covered for my family. Also have a look at what services does the super fund provide, what member services, education and support they provide. There are a lot of super funds out there. There's a lot of written information, but ring your super fund. That's what they're there for. Super fund is set as it's like a set and forget. Oh, I'll look at it in 5 years or 10 years or something. Be that annoying client that rings them a lot and say, I want to understand more about my super, because it does affect thousands of dollars in your super fund at retirement age. So the effect over the long term could be quite significant. So that's my mission today, is empower you to at least review and look at this as a way for the future, and make sure you set a strategy up for yourself, your business, and how you can how it suits you. And here are the tools that the ATO's got for you. So there's an ATO tool. There's the ASIC's Money Smart website that has a tool as well. And there is also some other comparison websites. I just put them there so you can look at some more options. These are in the workbook, and I've actually typed out the web address in the workbook so that if you print your document, you can still find these sites. Okay. Now, any questions around that before I move forward? Okay. So I did touch on this, but we're going to talk about finding and consolidating lost super. Okay. So if you sit there and go, oh, I had a super fund when I was working as a checkout, when I was 16 or 17, I can't remember what it is. Well, would have been about 20 years ago, the government made sure that when they created the MyGov account, that they put all of those funds into your MyGov account. So if you go into your MyGov account, making sure you can get to the ATO section, go under the super tab, that should give you information. What else you can find in that MyGov account is also what sort of carry forward super caps that you have. Okay. And so when you, every year you have a superannuation cap of 27,500 or 30,000. And if you are not contributing that much, you have what's called an unused cap that gets carried forward. You can find that information in your MyGov account, and it's very useful if you come in a big windfall of money and you're looking for ways and things to do with that money that is going to be tax effective as well as beneficial for your well-being, your future financial well-being. As I mentioned before, check the insurance before consolidating. I have many clients that will sit there with 2 insurance policies. They've moved to they've created a new policy, a new super fund that has better returns. However, they keep a portion of the money into the previous fund that covers for the insurance. So you don't want to get it where you've missed out. You've been paying years of super premiums and then there's just nothing left at the end of it, and you can't claim. Another tip also we're talking about, I talked about life, TPD and income protection. Income protection insurance is also something that can be deductible in your tax if you pay for it outside of super. Okay, when we're thinking about tax, we're thinking about anything within your income that that the government can tax. And income protection insurance, because it protects your income, it is deductible in your tax return, and it is also if you do happen to need to make a claim, those premiums that you receive for income protection like the payments you receive for income protection are actually taxed. Okay, before you jump in, the MyGov makes it really easy to combine your super funds. Don't just jump in and click, and don't jump in and pick the fund with the highest balance. You want to check for exit fees. You want to check investment options, and you want to compare the fees. Also, before you go do that, if you do happen to go back into the workforce or have an employer, make sure they can contribute to the fund as well. And one thing, I've actually had a couple of clients burned by this. They contributed to a super fund. They completed their notice of intent to claim. It wasn't yet processed. They then went, I'm going to consolidate my super. They moved their super and there was no evidence of and they couldn't claim the tax deduction because all of the consolidation of the super went into the super fund under a different notation. So they did lose the benefit. So make sure that all notice of intent to claims are completed and processed, and that you've completed out the financial year in your tax, and that you've actually claimed it in your tax before you go consolidating. That is if you have put a personal super fund. Buying property in an SMSF, yes, you would definitely need to speak to a SMSF specialist on that sort of thing. There are a lot of rules and a lot of compliance, and the ATO is very strict on their compliance with SMS super funds, and they must be independently audited. So yeah, having a chat about that and with a SMS specialist is the way to go. Insurance in a super fund option. Right. Any question? Does anyone have any other questions for me on consolidating your super fund, on any tax benefits in your super? I know I didn't touch a lot on what's called Division 293 super, and what's going on in the government with the ATO and the government at the moment when they're looking to tax high income, high super balances. We're looking at balances of around $3 million. Okay, we know that Greens are wanting to reduce that balance to $2 million. So if anyone on here has a wonderful balance of $2 million, then you might be wanting to speak to an advisor as well, because there are laws and new laws and changing laws coming in. Division 293 is that 30% on super for high income earners. And that is something that you would have to be earning $250,000 a year of your income plus your super contributions before you need to be hit with that. So anybody who's under 250K, 15% is your superannuation concession tax, concessional tax. One thing that you also might like to consider, if you are moving into that higher tax bracket, so think about yourself as an ABN support worker And if you are wanting to think of yourself about as the employer, and sit there, just mimic what would happen in a normal employee-employer situation. You have to pay super towards an employee. Why would you not pay yourself super? It's really important. Also, it's like a business expense. If you were treating it like a business expense, say, oh, I've got this income, I've got this percentage going to tax, I've got this percentage going to super, it is a business expense. It's put somewhere differently in the tax return. It's not put in the business schedule and tax return, but in your mind, if you're thinking about it as a business expense, then that's interesting. If you're looking at retiring in the next 5 to 10 years, what would be the minimum balance to live comfortably? That is very subjective. And as I am not a financial planner, I can tell you, you know, how much you'll save by putting this much money into super, or what your thresholds are, or what benefits you have available to you. But understanding what your minimum balance should be to live comfortably, sorry, I'm not your girl on that one. But I think it is probably a bit subjective for many people. Okay, great. I love this question. So we've got another question come through, and it's a question about Super Sync. So we've got 8 minutes, and I'm going to go back and explain this in a little bit more detail for you so you can see how the tool. But just to let you know, we are partnered with Mable. We provide discounted services to Mable ABN holders, and we work on all levels. If you're a starter and you just, you know, have a little income or you're supplementing your pension or something like that, we have business starter packages. We have your middle of the range packages for people who are not registered for GST, and then we have those with GST. I also want to let you know of the upcoming webinar that we are having in July. That's going to be all focused around tax, deductions, motor vehicle claims, all of those important things to reduce your tax, whereas today was quite the focus on super. But I'm going to bring us back to tax and super sync. So the way it works, it's within your Mable platform, and it's a separate bank account. So what happens is from your invoicing, you decide how much you want to be taken off your invoices for super. So if you popped in there 10% and you had your earnings, let's say your earnings was $10,000, they would pop $1,000 into your super sync account. Now, you have to remember, this is a bank account. This is not your super fund. They don't have the licensing that allows them to contribute directly to your super fund. There's a lot of rules around super, but it is a great tool that means that you are putting money aside without it disappearing in all of the expenses that we have. And so what happens then is you will go to that bank account every 3 months or annually, and making sure you transfer that as personal super contribution to your personal fund. So Tash is really good at understanding the features of the plan, or you can help give a call to customer service. I think it's easy enough to set up online and manage it online. But what it is it's a tool that if this month this quarter you earned $10,000 and next quarter you earned $5,000, it's taking the same percentage. Okay, it's not going to take, you know, $1,000 every quarter, and it might take 500 the next quarter. So it's consistent. However, it is your responsibility to make sure that super contribution goes into your super fund. Excellent. And the same with tax. Okay, it breaks my heart when at the end of the year we get people, we come and do their tax, and I say, how much have you saved for your tax? And they're like, oh, nothing, and they're losing sleep and they're stressed. You don't want to be overwhelmed, losing sleep and being stressed about paying your tax. Sadly, it's something we all must do. but being structured and strategic and planning it and having it put aside is really great. Okay. And if your income fluctuates, then that's okay. It's only going to withhold that percentage of that earnings for that month. So that's where it's a good little tool if you're not managing it yourself. Okay. Any other questions before I finish this up? It was make sure we finish before 5 because I know you've got families to get to, dinner to feed, and clients to look after. But if there's any other questions, feel free to pop them in the chat. I've got a few more moments to be able to answer them. And I'd like to see, if you want to pop in the chat, I'd like to see, were there any of those government benefits that you think are useful to you, or also that, you know, has this webinar changed your focus on super? Is it something you sit there that I wasn't thinking about seriously before, but now I think I need to think about it a bit more? So, and super is one of your quick wins to reduce that tax that is payable, but it's also investing in your future. So that's what I like about it from a tax agent perspective. Okay. So I want to thank you all for joining the webinar this afternoon. You got to hear me talk for an hour. I'll get Tash to come back in, and Natasha, you can take over if you like.
Yeah, thank you, Emma. That was so informative and really beneficial. And great to see everyone's comments and questions in the chat. So we'll be sending out a copy of the recording tomorrow along with the workbook. And also next month, we will be hosting our annual Independent Support Worker Summit, which will be live streamed online. We'll be sending out details this week. So just keep an eye out on your emails. But thanks again, everyone, for joining, and hope you have a great evening. Thank you.
Thank you all.
Bye.
Bye.